Imagine building a company around something almost deceptively simple. Shoes made from wool. No synthetic foam, no celebrity hype machines, no decades old sportswear manufacturing history. Just a new brand that said that footwear could be a bit softer on your feet and a bit kinder to the planet. That was the founding idea behind AllBirds. But what makes this story interesting isn't the shoes. It's what happens when a really simple idea collides with global competition, financial pressure, and a rapidly changing technological landscape. Because today, Allbirds isn't trying to design better footwear, it's trying to redefine what kind of company it even is. And that definition involves something far removed from, wool, laces and shoes. It's artificial intelligence, and more controversially, AI infrastructure. Welcome back to the Strategy Show, the podcast that connects real-world business events with the strategy concepts that actually help us understand them. I'm Ben Dixon-Green, and in this episode, we're going to explore how Allbirds evolved from a startwear footwear disruptor to a public market disappointment to a company that's now being linked to what may sound frankly bonkers move into AI, GPUs, and cloud-related markets. Allbirds has actually gone as far as to rebrand itself as New Bird AI. Now, at the date of this podcast going out, this is all pretty new, so they don't even have a logo for the new company. I made this one up, ironically using AI. Hopefully by the time you watch this, they'll have come up with a better brand logo than this. Anyway, the big question is this strategic reinvention or is it strategic desperation? And how do strategic models help us understand such a completely bizarre strategy? Well, let's start all the way back at the beginning. Allbirds was founded in 2016 by Tim Brown and Joey Zwillinger with a deceptively powerful proposition. Make better shoes using all natural materials. Their early innovation was called the Wool Runner, and it became a symbol of what was known as ethical minimalism. From a new business perspective, the early model was actually unusually put together and coherent. The company had a solid value proposition: comfortable, sustainable, minimalist footwear. It was attractive to key customer segments, so it was targeted to urban, environmentally conscious millennials and professionals who had a bit of spare cash. It had defined distribution channels, so it was direct to consumer, e-commerce, and it had some flagship retail stores. It had a strong brand story. It was natural materials. It was design simplicity, there to hook in customers. And for investors, it had very exciting revenue streams that built from those factors. So they sold premium footwear that was priced roughly $95 to $160 a pair, with the high materials costs offset by direct selling to the customer, which allowed Allbirds to avoid having to share its sales income with distributors and retailers. At its peak growth stage, Allbirds grew very rapidly, reaching revenues in the region of $200 million annually by 2019-2020. But the deeper issue with this company was already forming beneath the surface. Growth was happening faster than profitability. In 2021, Allbirds went public on the NASDAQ in the USA. At its initial public offering, or its IPO, it was valued at about $1.7 to $2 billion. Now, its revenue was still just over $200 million annually, but the narrative that sold the shares at that high value was that it was a sustainable consumer brand with a solid base that it could use to grow globally. Now, investors initially bought into this story. They saw this as like a new generation Nike, but one that was actually built on sustainability, which is kind of a key issue nowadays. The problem for Allbirds was that markets don't price stories forever. They price performance. And what happened after that kind of initial public offering was unfortunately a structural reset. Over the following years, Allbirds started to see slowing revenue growth, increasing net losses. They lost hundreds of millions cumulatively post-IPO, And because of that, they ended up with a share price decline of over 90% from those initial highs. So the question becomes, why couldn't the model scale? Why did the business not work? Well, let's apply Porter's 5 forces to understand the industry pressures. The competitive rivalry was extremely high. AllBirds kind of sits between global giants like Nike and Adidas, and then kind of smaller, fast-moving direct-to-customer brands. Now, all of these had much more well-known brands than AllBirds, and a much bigger budget for marketing and product development, as well as huge economies of scale. So these companies also then started to offer eco-friendly footwear options, but they're able to do it at a significantly lower price than AllBirds could. Buyer power was very high. For all customers act individually, customers can and do easily compare prices online, check sustainability claims, and compare product designs instantly. So rival companies were able to offer similar products to those made by AllBirds at lower prices, and customers could find those deals really easily. On top of that, customers were becoming more and more price conscious. The final problem within the industry was that AllBirds was impacted by supplier power. Sustainable materials are limited and they're more expensive. So maintaining access to the raw materials it needed was an increasing challenge and increasingly expensive, especially as you had larger rivals also kind of moving into the sustainable footwear market. So the industry conclusion is simple. AllBirds built a classic differentiation strategy, but it did it in a market that rapidly just absorbed and copied that differentiation until everyone was doing it. Now, we can also get a look at AllBirds' kind of wider environment using pestle analysis, just to get a feel for those issues that were impacting on them from outside their industry. AllBirds faced a really tough economic environment. There were strong inflationary pressures in their key markets, there still are, and that reduced discretionary spending by customers. So for high-price shoes like those that AllBirds offered, this led to customers becoming very price sensitive. As other brands started launching sustainable shoes at lower prices, AllBirds struggled to maintain their sales. On top of that, we had political and legal requirement changes. So ESG reporting led to increased scrutiny of sustainability claims and higher reporting costs for AllBirds as well. So all this external analysis points to really one major issue for the company. What once made AllBirds unique was now expected by the market. Now, AllBirds tried all sorts of different strategies to deal with this. You can almost sense them working through Ansoff's matrix and ticking different bits off. They tried market penetration. So they had some early success with kind of strong advertising and brand development campaigns. They tried market development. So they tried to expand globally into new countries. They tried product development. So they diversified into clothing lines to try and pick up more money from customers who'd already bought into the AllBirds brand. But none of them resolved the core issue. They were running a really expensive operating model in a highly competitive market. They had retail expansion through owning their own stores, but that massively increased their fixed costs. Insistence on sustainable sourcing increased their unit costs. And the brand premium that they'd built up just couldn't fully offset the pressure on their margins. Basically, people just weren't willing to pay that extra money just because of the brand name that AllBirds had built. So AllBirds had brand value, but it didn't have an easy way to defend that brand against other companies that basically copied them and did exactly the same thing, but more cheaply. Now we reach the critical strategic turning point. AllBirds has announced plans to move into participation in AI infrastructure, including AI computer markets, GPU procurement, AI-related infrastructure, cloud-based services, things like that. Now, to help fund this, it sold its trainer brand and assets, essentially the entire core of what the business has done historically, to a conglomerate retailing company. Now, this is a fundamental shift because this is no longer a footwear company. It's a consumer brand, that's decided some reason to become part of the AI supply chain. As we mentioned, even going as far as to rebrand the company to Newbird AI. And that changes the entire strategic logic of the company. First up, why? Why would a business do this? I mean, there are several pressures that explain what feels like a really bizarre diversification move. As we mentioned, post-IPO, AllBirds has faced sustained losses and declining market confidence, with share prices falling by over 90% from their IPO levels. Firms under pressure often pursue high growth strategies to change investor perception and kind of boost the company's image with shareholders who might be getting increasingly unhappy with the company. So your shareholders are upset, so you try something new. Now, small exposure to high growth sectors does give the company options. So if they kept their footwear business but added in other clothing items, for example, it does kind of widen their options in the long term. But AI infrastructure is way more than that. That's not dipping your toe into a new area while you still focus on your core business. It's a fundamental, massive pivot into a really new and really risky area. Now, let's redo the analysis for this new direction. Let's go back to Porter's 5 forces to get a feel for how AllBirds is going to find the new AI market. The existing competitive rivalry is extreme. AI is dominated by huge existing companies with dedicated ecosystems, companies with vast budgets and insane levels of skill. Supplier power is extreme. GPU and AI supply chains are controlled by a small number of very dominant firms. There's a lack of skilled staff needed on the open market to run these operations as well. And the entry barriers are exceptionally high. It is a very capital intensive industry and it's very technically complex to get into. It's one of the most competitive and capital intensive industries in the world at the moment, AI. So even though AllBirds has recognized that, as a fast growth industry, there are gaps in the ability of existing firms to supply the graphic chips and deal with the infrastructure that people need, so that there are profits to be made here, the question is really whether AllBirds is the one to make them. Because even if we look internally, there are serious questions over this proposal. Traditional AllBirds value chain and management skills are based around quality design, branding, sustainable sourcing of raw materials, retail distribution. That's where they add their value and that's where their management skill is. AI economy value chain is built around massive infrastructure procurement, cloud systems engineering, capital market skills, because you need loads of cash. There's minimal overlap between the two. So this isn't just adjacent diversification. AllBirds arguably has no skills in the new area that it's proposing to expand into. So let's pull this all together. This strategy raises several massive concerns. First off, the capability gap. There is no evidence of transferable expertise from AllBirds into infrastructure markets. We would worry about the capital intensity of the new market. AI infrastructure requires sustained, heavy investment, well beyond what we can be confident that AllBirds can raise. There's kind of a strategic distraction to all this as well for most businesses. Can the existing managers actually make a success in the new industry? Like we said, they'll probably lack the skills to make it work. And as for the shareholders, well, they bought shares in a shoe company. What are they going to think about a new risk profile of moving into artificial intelligence? There's also kind of brand dilution. Trying to be a sustainably led company and an AI investment company would confuse the brand for investors and customers alike. Now, to be fair, the company's trying to deal with that by rebranding to be clearly an AI-focused organization and offloading the traditional sustainable footwear industry that it was based around. And finally, there's just an execution risk. There's feasibility here. AllBirds has got no existing ecosystem position in AI supply chains. Where is it going to source its materials from? Who's going to buy them? So I suppose the question is, what on earth is going on here? Well, there are kind of, I suppose, three plausible interpretations when you see a company announcing major diversifications. The first one is sometimes a narrative repositioning. In other words, it's an attempt to improve how investors perceive the company. And for example, the announcement of the shift to AI did significantly increase AllBirds' share price, at least for a while. However, this would only be a temporary impact. And if the announcement was made solely for that purpose and the company didn't have any intention of significantly going into AI, well, there'd probably be legal issues with that anyway. Some companies will do this as experimental diversification, so kind of small scale exploration of a new area like AI. So some money would be used to experiment with the expansion into AI infrastructure just to see if it's feasible. But AllBirds has rebranded the whole company and sold its core footwear brand, so that's not happening either. What we seem to have here, quite unusually, is a genuine pivot. There's a full reinvention of the company from footwear into AI infrastructure. It's unclear how this is going to play out reasonably because it just seems so unlikely, but that does seem to be the direction that the board of AllBirds is taking. So AllBirds is now a case study in strategic pressure evolution, if you like. It's moved from an eco-friendly brand differentiation to a company that financially underperformed and had increasing pressure from investors, and it's then moved to become an experimental, high-risk strategic repositioning. Now, when their core strategy weakens, firms often reach out for high-growth ideas, sometimes with a hint of desperation, but not all the ideas are good ones. Not all the ideas they have are strategically coherent. So the question here isn't really whether AllBirds can make better shoes, it's whether as New Bird AI, it can survive long enough to justify its reinvention into something far removed from where it started. Because really, in strategy, the most dangerous move isn't necessarily standing still. It's changing direction without the capabilities to support where you're going. And right now, New Bird AI is betting everything that it can manage that successfully. Thanks for listening to The Strategy Show. If you've enjoyed this episode, or you found it useful, or hopefully both, please make sure to follow so you don't miss the next one. And if you've got any thoughts or questions, drop them in the comments. See you next time.